Are you making these common mistakes when investing in gold? Welcome to the world of gold investment, a realm glittering with potential rewards but riddled with pitfalls for the unwary. We're diving into the top 5 common mistakes people often make when investing in this precious metal. Crucially, each of these mistakes is avoidable, and this video will arm you with the knowledge to sidestep them. So hold on to your hats, folks. Stay tuned to discover how you can avoid these costly mistakes. The first common mistake is not doing enough research. Yes, you heard it right. Research is the cornerstone of any successful investment decision, especially when it comes to gold. You see, gold isn't just a shiny metal that we all love. It's a complex financial asset with its own set of rules. And those who choose to ignore these rules often find themselves in a sticky situation. Let's delve into this a bit. Imagine you're buying a new car. You wouldn't just walk into the dealership, point to the first car you see and hand over your hard-earned cash, would you? Of course not. You'd research the car's features, compare prices, check for reliability. The same principle applies to gold investment. You need to understand the market, the factors that influence gold prices, and the different ways you can invest in gold. For instance, did you know that gold prices are heavily influenced by global economic trends, geopolitical events, and even the strength of the US dollar? These are the kinds of nuances that can make or break your investment. Furthermore, you should also be aware of the different ways to invest in gold. Physical gold like coins and bars is one option, but there are others like gold exchange-traded funds or ETFs, gold mining stocks, and even digital gold. Each of these investment avenues has its own set of pros and cons, and it's crucial to understand these before making a decision. Also, don't forget to research the sellers. Whether you're buying physical gold or investing in a gold ETF, it's essential to ensure that your seller is reputable. There are plenty of unscrupulous sellers out there who would love nothing more than to take advantage of uninformed investors. In short, research is not a step you can afford to skip. It's the foundation upon which successful gold investments are built. It's the tool that will help you navigate the often turbulent waters of the gold market. Remember, lack of research can lead to poor investment decisions. Don't skip this step. The second mistake is overinvesting in gold. This is a common pitfall many investors tumble into, driven by the allure of the glistening yellow metal. However, as with any investment, there's a risk involved, and gold is no exception. Overinvesting in gold can be likened to putting all your eggs in one basket. It exposes you to a higher risk of large losses. Consider this scenario. If gold prices take a plunge, and gold is the only asset you've invested in, your entire portfolio takes a significant hit. Gold, while a valuable asset, is still subject to market volatility. It's not immune to fluctuations, and its price can go down as well as up. If you've overinvested, the downturns can be pretty hard to stomach. This is where diversification comes into play, a fundamental concept in investing. Diversification is essentially spreading your investments across a variety of assets, including stocks, bonds, real estate, and yes, gold. This strategy is designed to balance out potential losses in one area with gains in another. Remember, each asset class comes with its own set of risks and rewards. While gold can act as a hedge against inflation and market instability, stocks and bonds can provide income and growth potential. Real estate, on the other hand, can offer steady cash flow and tax advantages. Diversification doesn't guarantee profits or protect against losses, but it can help you manage risk and potentially enhance your long-term investment outcome. So, instead of going all in on gold, consider how it fits into your overall investment strategy. Think of your investment portfolio as a pie. Gold should be a slice, not the whole pie. The size of that slice will depend on your individual circumstances, financial goals, risk tolerance, and investment timeline. The key takeaway here is not to get carried away by the glitter of gold. It's essential to maintain a balanced and diversified portfolio that aligns with your investment goals and risk appetite. Overinvesting can be risky. Always balance your portfolio. The third mistake is buying at the wrong time. Investing, in many ways, is a game of timing, and with gold it's no different. The relevance of market timing in gold investment cannot be overstated. Buying at the peak of the market can lead to significant losses, just as selling at the bottom can. Let's think about it. You've probably heard the adage, buy low, sell high. It's straightforward advice, yet it's one of the hardest things to achieve in investing. When prices are high, there's a general euphoria in the market, and it's easy to get caught up in the hype. thinking that prices will continue to rise. Conversely, when prices are low, the sentiment is usually negative, and it's tough to gather the courage to invest. However, it's at these low points where the greatest opportunities often lie. Warren Buffett, one of the world's most successful investors, encapsulates this concept perfectly in his famous quote, "Be fearful when others are greedy and greedy when others are fearful." So, how do you determine the right time to buy gold? There's no foolproof method, but there are indicators that can guide you. Gold prices are often inversely related to the strength of the economy. When the economy is strong, gold prices tend to be lower, and vice versa. Therefore, keeping an eye on economic indicators can give you clues about potential shifts in gold prices. Another tip is to take a long-term perspective. Gold is a stable asset that has maintained its value over centuries. It's not something you buy today and sell tomorrow for a quick profit. A long-term approach can help smooth out the short-term price fluctuations and reduce the impact of buying at the wrong time. Lastly, remember that it's better to be approximately right than precisely wrong. Trying to time the market perfectly is a fool's errand. A more sensible approach is to invest consistently regardless of market conditions. Timing is crucial in gold investment. Don't rush into buying. The fourth mistake is failing to verify the authenticity of the gold. This is an issue that's more common than one might think. In the quest for gold, it's easy to let your guard down and assume that all that glitters is indeed gold. But this mistake could cost you dearly. Counterfeit gold is a reality in the marketplace, and it's not always easy to distinguish from the real deal. Fraudsters are becoming increasingly sophisticated, using advanced techniques to make fake gold look and feel like the real thing. They might use real gold on the surface to trick basic tests, but underneath, it's a different, cheaper metal. So how can you ensure the gold you're buying is genuine? Let's discuss some tips. First and foremost, buy from reputable dealers. These are businesses with established track records and positive customer reviews. They are less likely to risk their reputation by selling counterfeit gold. Secondly, always request a certificate of authenticity. This document verifies that the gold you're buying is genuine, but remember, certificates can be fake too, so it's important to verify the certificate with the issuing authority. Another method involves testing the gold yourself. There are several ways to do this, from simple acid tests to more advanced electronic testers. You can also check the weight and dimensions of the gold, as these should conform to established standards. Lastly, consider getting your gold appraised by an independent third party. While this may involve an extra cost, it could save you a lot of money in the long run. Remember, verifying the authenticity of your gold is not optional, it's a necessity. It's better to spend a little time and money up front than to discover later that you've invested in worthless metal. So whether you're a seasoned investor or a newbie to the world of gold, don't let the shine blind you. Be diligent, be skeptical, and most importantly, be sure. Because when it comes to investing in gold, it pays to know that you're getting the real deal. Always verify the authenticity of your gold. Don't fall for counterfeit. The final mistake is not considering storage and insurance. Picture this. You've acquired a substantial amount of gold, yet where do you keep it? Stashing it under the mattress might make for an interesting tale, but it's far from practical or secure. Secure storage is crucial to gold investment. This can range from a home safe to a deposit box at your bank or even professional vault services. Each option has its pros and cons, so it's essential to weigh these based on your unique circumstances. Now let's talk insurance. It's the safety net that catches you when unexpected events occur. Without insurance, theft or damage could lead to significant financial loss. It's crucial to ensure your gold is adequately insured, covering its full replacement value. Remember, storage and insurance aren't just afterthoughts. They're integral parts of the gold investment process, essential to safeguarding your treasure. Don't overlook storage and insurance. They are key to protecting your investment. That wraps up the top 5 mistakes to avoid when investing in gold. Remember, thorough research, balanced investing, timely purchases, verifying authenticity, and considering storage and insurance are the cornerstones of a successful gold investment. Each step is crucial, and skipping any can lead to significant setbacks. So tread wisely in the world of gold investing. Avoid these mistakes and you'll be on your way to successful gold investing. Thanks for watching.